Mattis, thank you so much for joining us here in Power.
It's a pleasure.
Great to talk to you this afternoon. And first, let's just start off by maybe you describing the current allocation to private assets across different wealth channels that you have and how you've seen that allocation evolve, I guess, over the last year or so.
Yeah, I'll probably take a step back and look at private wealth in alternative assets, private investments. I'd say wealth, high net worth individuals have invested for a long period of time, for decades, in illiquid private assets, real estate infrastructure being the obvious one, but they've invested in private equity for a long, long time, very successfully. And I'd say the allocations to private equity have been very successful and highly returning, so they have increased it further and further. The natural next step from private equity is private credit. And what we have seen over the last years is that investors who've done private equity for a long period of time have naturally morphed into private debt investments. It's a natural extension because the way we invest, we back private equity buyouts just on a first lien senior secured basis. And we for that have less volatility and less risk. I would say both in wealth and the institutional investors are increasing private equity and private credit allocations these days.
So where do you see the greatest opportunities in the next sort of year to 24 months for asset managers in those terms?
Look, for asset managers broadly, I think that is a very broad question, and we could go into very different directions. For private credit, private debt funds specifically, I'd say for the larger managers in Europe that have done direct lending, first lien secured debt, what I've talked about, specifically, I think the current environment is very attractive to invest in first lien debt for LBOs, 30-35% loan to value, double-digit yields that you're currently getting. The environment is so attractive, and if you've done it for a decade plus, you'll be able to access the right companies backed by the probably top decile, top quartile private equity sponsors and generate very consistent good returns for your investors. So I'd say our direct lending, core direct lending platform is where we see the best value for the next 2 or 3 years. On top of that, capital solutions can also be a nice addition.
And are you seeing that's areas and that you're perhaps seeing opportunity? Are you seeing in product innovation as well that's going to change the landscape at all in terms of what private asset products are out there too?
Yeah, I think for the products we're offering, and we're offering a wealth of products to our institutional clients, which we're adapting for the wealth channel. Usually our funds ramp for two years, then stay invested, and then ramp down at the end of the fund product. That is okay, and that's how the asset class evolved, similar to private equity funds. But most of the investors who've invested with us want to stay invested for a longer period of time consistently. So we have created evergreen funds for the institutional investor class that now family offices and others are also using.
What are you seeing is probably the most prevalent at the moment in terms of the...
Now, in our fund structures.
Yeah.
Look, we have been built as an asset manager targeting institutional clients, and we have regular way 4-year investing, 3-year harvesting, 7-year locked up structures. That's what we have always done in the past, and that works well for most of our investors. Some now go evergreen, and then the wealth channel is an addition. And the wealth channel needs different products, different minimums, different channels to target them. That's all what we have built and are building. That's why I'm here.
Obviously talking about most prevalent product there, but perhaps we are seeing a shift in what managers need to do because the economy and the environment is tougher. You've got to work a bit harder to make those sort of returns.
I would disagree. I think especially when you look at private credit or private debt, the last decade at 0% rate, I'd say fundraising for the investors with track record, for the larger investors, and we've invested almost 30 billion in private credit over the last decade, it's quite easy because people get it. We're doing 30% loan to value, double-digit yield, very low risk on the bluest chip companies. It is quite attractive. Fundraising from institutional investors has been easier than I'd say a year or two ago, and they're increasing private debt allocations. Having said that, the wealth channel is very important if we want to scale our firm and we want to scale our fundraising abilities over the medium term.
Obviously, Nuveen's very well established and known in the States, but you're here in Europe at Empower in Monaco.
Yeah.
It's a great opportunity for you. Tell me about that and why you like being here and what you get to do.
Look, Nuveen is extremely strong on fundraising and distribution, no doubt. We were acquired by Nuveen 18 months ago, and we're using the Nuveen distribution power as much as we possibly can for our funds. Arcmont is a purely European, Western European focused private debt fund. So our core investor base is European. We spend a lot of time with our investors in France and Germany, all across Europe, to raise, and then we also only invest in Europe. So we are natural that we're here, and we like to be with our investors where they are.
You're confident in your track record, if you like.
Yeah.
Thanks so much.
So.
Great
Thank
to hear
you.
your insights today. Thanks.